Good day, everyone. We see the S&P coming right up to its 200-day. The Dow has moved past its 200-day, and this bounce, defying all logic, continues. Oil is now approaching $40 a barrel. Of course, these bounces, as we've said before, can last longer than anyone would expect, especially in this age of quantitative easing where markets are manipulated by central banks across the board. It's no surprise that the ECB has taken an even more aggressive stance toward pushing rates into negative territory to a greater degree, with no clue of how they're going to unwind all that. Also, the central banks, including the Fed, seem to think low rates will get people to borrow, but they all fail to see that lower rates rob savers of income. They potentially will destroy pension and insurance funds, and the debt is leveraged to enormously dangerous levels. And so the sovereign debt crisis is right upon us, and people will not borrow or spend, and businesses are not going to hire or expand when they have no confidence in the future. You just can't stimulate an economy with lower rates while crushing it with taxes. And these governments across the board are dead broke, and they're hunting money. They're hunting money via taxes, and they're doing it any which way they can. Now, one interesting note yesterday was that the ECB said it would start buying debt issued by companies, corporations, as well as governments. And of course, that would normally be good news since corporations have to pay back their debt, unlike governments. And it also encourages corporations to expand and hire. So it actually does help corporations that are healthy to be buying corporate debt. But the debt that they will be buying, unfortunately, will be riskier debt. It sounds like the riskiest debt of entities that are in trouble. So in a way, it sounds like it's just sending more good money after bad. So all that's to say that this bounce, we can't underestimate the power of central banks. They have manipulated markets higher since 2009. They are struggling to do so. They struggled last year. You can see that when countries go into negative rate territory like the ECB or Japan, these markets, their markets are down since that policy shift. So negative interest rates are not helping, and it also has a tendency to make banks charge their clients a higher rate of interest to cover for having to pay the Fed a negative, or rather a rate of interest just to park their money. So the thing of it is that any manipulation is going to be met with a counter manipulation, and that's what we're seeing being played out. And of course, the economy, which supposedly is the real reason why these central banks are doing what they're doing, continues to, it continues to be a very sick patient. And these central banks are continuing to medicate the patient with all this easy money. But it's like putting a Band-Aid over a nasty infection. It's not going to do a damn thing until you get into that infection and actually make some meaningful cure or remedy for that infection. So at any rate, we're trend followers in terms of trying to catch the major trends. That's what the market direction model attempts to do. Of course, it can't really do that in trendless environments. But it seems like there was a material change that happened starting this year, and that model has gone back to adopting some of its old rules, which seem to be in play once again, as quantitative easing in the U.S., for the time being anyway, is on hold. That's not to say the Fed won't also adopt a negative interest rate policy. And again, if it were to do that, There is a big price to pay for that, and I think the markets are expressing a lot of exhaustion, which started last year with the markets trying to be pushed higher artificially, but refusing to really move into a new high territory by any meaningful amount. And instead, we have two back-to-back corrections. The first one in August of last year, which is very steep, and then we had another one in January. And this has only happened twice, I believe, in history, going back to 1929, before the Great Crash, and I think, but also before 2008. But I'd have to check the history figures on that. And also, I think it happened in the year 2000. So these were periods that preceded great corrections in the markets. And it seems like that's what the market is wanting to do, because the fundamentals are just god-awful. The writing's on the wall. But nevertheless, it is a tug-of-war between what the central banks can do and what the real conditions are. And it's always been said, never underestimate the power of the Fed. Don't fight the Fed. And that's equivalent to saying don't fight the tape. So as long as we're going in an uptrend here, and the market direction model continues to sit on its buy signal. Meanwhile, the VIX volatility model, I sent out a note yesterday, which I hope you all read. And that's basically to say that we're all human, and it is my mistake in not taking all of the model signals and delaying one of the fail-safes, and that costs the model performance. But the good side is that the model is working great. If I had taken every single signal that the model has issued this year, it would be up handsomely, and that's not even taking into account the 15% plus, in some cases over 20% gains that occurred within a day's time when the VIX spikes. So on the sell signals, rather on the buy signals, where the model is buying volatility, the VIX model will incorporate certain profit-taking measures when it deems fit. I went back through all the data, years and years of data, and was delighted to find that there's actually a very high correlation to taking profits early in the right buy signals and further pushing the profits of the model higher by quite substantial levels in some years. So that was a great surprise to me. And like they say, whatever doesn't kill you makes you stronger. And this market has been really doing my head in. And maybe it has been yours too. But the fact remains that this volatility is good for the model. The model likes it, and I'm going to do my best to take every single signal and not let my 25 years of experience in the markets tell me otherwise, because that's what caused me to override two of the signals this year, both which were profitable. One was extremely profitable, and it's profits like that that make all the difference to your P&L at the end of the year. So with all that said, I'm going to turn it over to Gil. But it looks to me like this market is just continuing to be in an uptrend, but always keep your stops tight, because as we know, we're still in a period of elevated volatility in this kind of market environment, this kind of market action, which started in late August, actually last August, has been unusually volatile, and I would expect this tug of war to continue. Thus, this volatility should also continue to play out. Gil?
Dr. K, we have a question for you. Someone wants to know, why do these banks pay to store their money? Why don't they just keep it in their safes for free?
Yeah, I think banks obviously will ultimately end up just sitting on their stash, and they're not going to lend it out. The economy and the faith in what's going on right now is I think, at all-time lows, and so banks are not willing to lend to businesses who need the capital to get their businesses going. And so the Fed, by reducing rates into negative territory, they, in their thinking, that will cause banks it'll force them to lend money out. But yeah, I don't see why they won't just sit on it anyway. They're going to find a way to sit on it. Or it's been said, I think it was shown over in Europe, that banks are parking their money at I think minus 0.5% rate But in exchange for that, they're charging their clients a higher rate of interest to cover their costs. So one way or another, banks are going to do what they're going to do, to fend off these attempted manipulations by the Fed.
Yeah, I think there's manipulation all over the place. The market's been rallying off the lows of mid-February, but most of the stocks that have done the heavy lifting have been junk off the bottom and what I like to refer to as ugly duckling type situations. And they're tradable, so you do have to look at things in a much more less orthodox manner if you're going to try and trade these setups. But they're there, and I think trying to chase breakouts or anything like that is not really recommended. We can see if we look at some of the names we've talked about recently. Whoop, let me get that right. SWHC, for example. Here you had a breakout 6 days ago, and it comes right in. You're better off trying to buy weakness rather than chasing the strength and then getting whipped out, because if you bought this breakout, that's probably more than about 7-8% on the downside, and it's basically a shakeout, and they take it right back up. So the best place to be buying this was down here originally, and then you can look at coming in on the pullback here if you want to, using the 10-day line as your stop. What was the other ones we put on? This MTSI, right, Dr. K? So here's another one, pulls in. It's best bought on the pullback in here and on weakness rather than chasing the strength. SEMO, Silicon Motion. Here's another one. I think it had a pocket pivot in here, but that pulls right into the 20-day. And now it's trying to turn and come out again. So you can see in most of these cases you have to step in on weakness, and you're better off trying to do that. And then the question becomes more one of where do I take my profits? Am I going to get long and strong and look for a big trend? And what you see in this market is it starts to stretch one way and it comes snapping back the other way. For instance, yesterday, we looked like we were going to be off to the races early in the day, and they're jacking everything up. I think the Dow was up 130 points. And within about an hour, I guess everything reversed. And now we start looking like we're going to just completely blow apart, and the market finds its feet. And actually, if you're paying attention, the pullback yesterday got down on the NASDAQ, got down as far as a 50-day line, which has been something we consider to be critical support for both of the indexes on any pullback. So you're getting this just a very volatile action around here. It makes it very tough to navigate because a lot of things were just getting hammered yesterday, so the market's looking like it's just going to come fully apart. And it doesn't. It hangs in there, and we turn back to the upside. And by the end of the day, I think that was the S&P actually up for the day slightly. Dr. K, it was, wasn't it?
Just slightly.
Yeah, but to me, it's mostly a day trader's market, and you buy the weakness. They come in, and you take a position, they turn them out to the upside, and then you try selling into that. I like to play like Amazon is a fun one. Coming into the 200-day, and it bops back to the upside, and then maybe you short it there and it comes back down to the 200-day. Maybe someday it'll get through that, but so far it's finding resistance along the 50-day moving average. And if you look at this objectively, this is essentially a sort of a head and shoulders. Maybe you're making this could be considered a second right shoulder, or is it coming out and going to blast to new highs in a glorious new uptrend? In the wonderful economy we have today, maybe their move into shipping drives them higher. I don't know, but you can see that you're in a position where it is finding resistance along the 50-day line. So until it breaks through the 50-day line, you can consider it a short along the 50-day line. But at the same time, you look at it off the 200-day, it could be viable, and so you can come in and just trade it back and forth. It's like this. I remember in the 1990s there was this commercial we saw, channelingstocks.com, where some guy was going to retire because he was able to channel stocks back and forth, I guess, as they moved around. You get a lot of that sort of action these days. So you see a number of these trying to come up, like you look at CRM, Salesforce. Now, similar situation, although kind of in reverse with respect to the moving averages. You can see the big gap up on earnings, but it's not really going anywhere. But it is running up into the 200-day line. It's holding above the 50-day line, so it finds support there and then jacks up into the 200-day, and it finds resistance there. So long, short, you short it up here, cover down here, go long, short it up here, and that's basically all you're seeing. You're not seeing any fantastic massive trending action. Give me 1 second here. My computer wants to restart itself. Can't do it now. We're in the middle of the market day. And then you can see something like Netflix. Same situation. You see that, but it's below both its 50-day and its 200-day. So I'm actually short this one today. It's down a nickel right now. It's been back and forth, but I think it's probably going lower. So there's that one. Splunk is another situation. It's hanging just above the 50-day, but notice how it's up into this area of overhead congestion. So this could be resistance, and so you're watching for a break to the downside here, which I think is a real possibility if the general market rolls over. So what's driving the rally this morning, Dr. K? Do you know for sure?
It's just a continuation of, I guess,
junk off the bottom.
Yeah, well, it's ECB stance that I guess ultimately, there's an issue with Draghi saying that this is the last of the rate reductions. But of course, that's just central bank nonsense speak. They're all supposed to say that, but ultimately they're going to do what they're going to do. So I think that's the smart money has said, yeah, don't fight the Fed, don't fight the central banks, and this rally is going to continue because we've got all these central banks printing money endlessly at this point.
Yeah, I mean, the thing is, you can't expect this to end well. Now that the ECB is going to be including corporate debt in the mix of securities that they're buying, bonds that they're buying, along with sovereign debt, they're just fueling what already has been a bubble in corporate debt over the last few years. If you look at increases in debt, consumers aren't increasing debt, but corporations are, and especially in the oil sector, that's been an area where you've seen a lot of issues cropping up that then weigh on the financials, and you've seen the financials come off as oil has come down. So I think oil right now is what is it doing here?
They're going to be buying. They're going to be buying junk, basically. Corporations in trouble, not healthy corporations.
No.
And that's kind of money. The kind of debt they're buying, and so consequently, if you look at HYG, which is the high yield index.
What is that? HIG? No.
HYG.
HYG.
HYG is high yield. It's junk debt basically, and if you look at a longer term chart of this, it was having a lot of trouble prior to the 2008 crash, and it's the downside. The downside has been accelerating on this, but it's recently had an upswing, especially on that kind of news, I guess. But ultimately, these companies are in big trouble, and you get banks, oil companies, others that are just, hanging by a thread. And, pouring money into companies like that is not good business sense. But that's what the ECB aims to do.
Right. And so you can see that I guess the high yield sector or bond sector, whatever you want to call it, is rallying up into this area, which might be overhead. So I think we are moving along with the price of oil. I was tracking it earlier. If some of you were watching my screen before we started the webinar. But yeah, it came down hard. See, now the bounce is being associated with the market coming back up. I still would be willing, or from my perspective, I'm looking at the market from both sides. I'm willing to go long on weakness. I'm willing to go short into strength. And so now you're seeing this rally, and the S&P is pushing right up into the 200-day moving average. So I'm wondering, do we have a failure here? Now I'm noticing Netflix is moving lower, so that's working as a short. Some other things that I'm looking at here, I've been putting this one out, is Tableau Software, which is basically in a pretty ugly bear flag here. And you can see it reverse off the 50 level here on this rally, the 20-day. And now it's kind of tucked along its 10-day line. So you could look at this in reverse, and you see like a bounce off the support off the 20 line. If you turn this upside down and looked at it in a mirror, and now you get the low volume pull back into the 10-day line. In this case, it's a pull up. So right around the 10-day line, we're coming in at 44.18. You can start dabbing it out and seeing if it rolls over for you. So those are the types of things I'm looking for. Workday is another one of these. Okay, now here you're between the 200-day and the 50-day. So resistance is found at the 200-day, and it hasn't yet pulled into the 50-day, but it is showing support so far along the 10-day line. But of course, it's down today in a market that's up. What are we up right now? 205 on the Dow right now. So that's pretty strong, but it's actually down on the day, and that's another one that's in a position where it could become shortable. In fact, I've been hitting it on rallies into the 200-day line and intraday. Yesterday I was able to short it and got a nice move, about $3 or so to the downside, and then of course it found support just underneath the 10-day, and it turns and bounces back to close mid-range. So it's very volatile. My approach is essentially a day trader's approach, because it's not like the old days. And I was talking about this the other day on Twitter, that in the old days, if the market started to do what it did yesterday, so for example, I came in and saw the market up, and so I hit it on the short side pretty heavy, and everything starts to roll over, and as things are coming down, in the old days, what I would do is step on the gas. I would double my positions, maybe even triple them, depending on what the initial ones look like or the size of the initial positions. And I would just step on the gas because I'm anticipating a continuation of the move. But in this market, how I've adjusted is what I'll do when I start seeing that is I will actually start backing off and taking profits and working my positions on an intraday basis rather than going all out and stepping on the gas. And that's what happens. And you saw yesterday was a perfect example of that. The Nasdaq got within about 10 points, I think, of its 50-day. I think it got down close to 47.08 or 06, something like that. And the 50-day line is somewhere around 46.90, I think, 46.95. I got to take a look at this. There's my data window. Let's see. It's 45.88 today, but you notice it's descending, so it hasn't turned back to the upside. And so, you get everything bouncing back to the upside furiously. And in my view, I'm going to say we're probably in a bear market rally. But we'll see. And I think you have to see how things develop. Some of these stocks are acting okay. You're getting some breakouts that are working, like the Smith & Wesson, but they're far and few between, and things having the best moves seem to be the things off the bottom. Here's Facebook, which can't really decide what it wants to do. It's running into resistance. If you look here, here's your failed breakout on the weekly. So it's running up into this area. So 110 seems to be resistance for it. Might become a real juicy short at that point. Or it has been actually. If you hit it there, it comes up here the other day, boom, you get a break below the 20-day, and now it's kind of wedging back up to the upside. I wouldn't be surprised if it rolled over again, maybe tested the 50-day again, but that's going to depend on what the general market does. And I would keep an eye on something like Facebook, because I think it's a critical stock for the market. If you see it start to break down, being one of the few that's actually held up within 7, 8, 9% of its peak, then I think you may be starting a new leg down. So same thing might go for something like McDonald's, but that doesn't want to give it up. What's that, Dr. K?
Utilities are on the verge of hitting new highs, new all-time highs. The Dow Jones Utility Index, and people remember in 2008 they were well ahead. They were well outperforming the S&P. There was a huge divergence going on there.
Right.
Seeing now.
Right, and you're seeing that. I mean, is that with stocks rallying though? It's kind of seeing that it's telling us that interest rates are going to remain low. I think gold has also continued to act pretty well. You got to buy it on weakness though. It's been holding the 10-day, and it's coming in right here. So, that looks like it wants to go higher. And there's the move on the weekly chart. So, like you were saying, one of the biggest moves in a long time for gold. So that all seems to be signaling that interest rates are going to remain low, or maybe even go lower. You have Europeans going further into negative interest rate land. You got Bank of Japan in negative interest rate land, or NERP land, negative interest rate policy, NIRP. And does the U.S. ever get there? We'll see. There's a lot of talk about how strong our economy is, but it's so strong that interest rates have to remain near zero. So not really buying it myself. Market's just trundling higher, up to 13 now. So any other questions here? Let's look at some other names that are actually working pretty well. Alaska Airlines, you had to buy that. We put that out as a pocket pivot. You got to buy it on weakness again. You see that? And it works and it's going higher. JetBlue got clobbered, so but the others in the group just pulled back to their moving averages. You have Southwest, same thing here, bounced off the 50-day moving average and goes higher. You have what are some of the Hawaiian Airlines just continuing to move higher, and it's holding along the 10-day line. So I guess you could watch for a continuation pocket pivot if you're interested in this name. So American Airlines, you can see these trying to move higher, Delta. So I think we like Alaska Airlines. That's when we put the pocket pivot alert out on. And you can play this one. You could have played this one on the pullback into the close to the 200-day moving average. Or some of the other ones. Did we put this one up? S Super Micro. Here's another. It's kind of weak in here, but maybe this is a spot to pick it off. So Solar Edge, another one, is trying to move up. It's holding along the 200-day moving average, so nothing terribly special there, but it is, here's a pocket pivot. It is consolidating it reasonably well, so that's kind of a go-to name, I think, if the market continues higher. Another one I've been keeping an eye on is First Solar, which came into the 50-day moving average. If you draw a line across these peaks here, you can see it held the trend line on the trend line breakout, but that's about it. Not really anything from there. You're getting a bounce, and I don't. Is volume up today? Let's take a look real quick.
No, it's off 26%.
See, so it might be setting up as a short here. That's a possibility. But you know, I'm watching all of these things as they rally, and I'll test the short side out on them, and I can also take long positions if I so choose. So I was looking at some other names here. Splunk we looked at. Let's see. Here's CyberArk, because it's holding along the 20-day and the 10-day line. It ran into some resistance as it approached its 50-day line. So starting to put the afterburners on the market here. Here's another one. Well, let's look at Palo Alto Networks because I think it's relevant to CyberArk. This one's moving higher. Here's another situation though where you've cleared the 50-day, and now you are looking at the 200-day up above. Maybe it's going to head that way and find resistance there eventually, but we'll see how that plays out. But you've seen how some of these, that's what they'll do. They'll rally up past the 50-day or past the 200-day and then find resistance at the next moving average. And I think it's key to watch how these things all act as they play out on the upside, because they may come back into shortable range. I mean, that's what a bear market rally does for you. It brings all your shorts back up into shortable range. And if you look at any of these stocks that I've talked about, these ugly ducklings, they've had huge breakdowns. And so now the rallies, you know, maybe retracing 50% of the prior downtrend, you're getting close to that area where that might be the case. So I think you have to keep a close eye on these, and I think they will tell you where the market goes from here. But, you know, where's the next big trend? It's hard to say. So if we look at cyber, you know, maybe that's going to head back up to the 50-day line. Let's see here. Godaddy. Here's one. I don't know if this looks very V-shaped to be a new base, so I'm a little skeptical about this one, although it did pull into the 20-day line where it could have been bought, and now it's kind of floating back to the upside, so I'm not really clear on this one. I think this is a little too V-shaped. It needs to spend some time going sideways, but that's one that's been coming back, and it's an ugly duckling. Now the question is whether it becomes a double pot or not, and it sort of has those characteristics as well. So, Dr. K, do you have any particular long ideas that are your favorites in this market currently?
Not really. I mean, the leading stocks are looking pretty languid, and the defensive names are the ones that are outperforming. And it's absolutely topsy-turvy kind of environment. So I'm not really seeing anything of note that's of any interest, you know, because it's a lot of it's junk off the bottom, and yeah, I mean, you can play those, you can swing trade those or day trade those, and if you pick the right ones, you can do well. But as far as position trading goes, I'm just not seeing anything. And if we do see something, of course, you know, we'll always put it out in the form of a report. But you know, we have put out a couple reports, but you know, these are it's like we're in the desert and we're looking for a drop of
Water.
water.
Yeah, I think O'Reilly was another one we put out, and that one's continued higher. So some of these are making some progress. I mean, it's not huge, so if you're a long-only type of person, there are some things to be in, and you just keep a tight leash on everything. If the rally fails, you're gone in a second. So personally, I like to see some massive reversal today that sends everything back to the downside, but market never does what I want it to do. But at the same time, treating it as a day trading environment mostly and being willing to look at it from either the long or the short side without any particular bias one way or the other, I can make progress. So I've been pushing the higher highs in my own account all year, and so that's a good sign. And it tells me that my approach does tend to work, and it also keeps me out of trouble when you get these crazy days like yesterday, which I think if anybody disagrees, I'd like to hear about it. But you looked at yesterday's action, and it almost looked for sure like, oh, this thing's just going to blow apart right here. You got the ECB babbling that was supposed to spark a big rally, and now we're plummeting to the downside. This thing's just going to come totally apart, and it didn't. So you also get the sense that we're not in a market where there is any real accumulation of stocks. It's not an investor's environment. There's no actual investment going on. There's just rotation back and forth in different sectors, and now they're bringing up some of the oils. So I've noticed names like ELG has been rallying. You saw Silica have a nice move, and it's backed into the 20-day. Now it's pushing back above the 200-day moving average. Maybe this thing is going to press higher. Maybe these are the new ugly ducklings that will help to take the market higher from here. We'll see. I think it's somewhat unclear at this stage, but a lot of these are starting to turn. Another one I saw was Noble. That's one, it runs up, pulls in. I think another Noble one here. This one ran up. It's pulling back into the 10-day moving average. Just a big stock oil name, and these are where institutions will go. You also is it Chevron or ExxonMobil? Yeah, that's it. Yeah, that's been trying to make new highs, kind of coming in today. So, but it's pretty uneven. You can see the choppy action. There is a trend here somewhat, but it's not what you would call, exciting, all that exciting. It's just very choppy and very uncertain. So, and it makes the whole environment difficult to navigate. And my feeling is if you're not going to trade it on a short-term basis and to some extent on a day trading basis, I think probably you're better off trying to stay in cash or working some of these smaller positions if you can pick them off on weakness. Some of these pocket pivots we talked about, you try to pick them off on weakness and get into a good position that way, and then hang loose and see if they are able to proceed higher. Now, my general rule would be if I were to do that, so let's say, take an example, let's say you bought this one. On the pullback here, my inclination would be to take a 10% profit once I had it. So as you run up to the highs here, you're kind of getting there. So it's sort of a situation where you're looking at this kind of V-shaped, and maybe taking a profit here makes sense. Or you could set a tight trailing stop, a dynamic trailing stop that ensures you'll get out with some sort of a decent profit no matter what happens. So that's the way I would approach it, just because you're not really getting any strongly trending moves. There aren't any situations out there also that strike me as being all that dynamic. There's no Tesla like we saw in 2012, Dr. K? There's no Ambarella move like we saw last year. There's none of that going on. It's just all sloppy and choppy and nothing really trending, and your best moves come on things that are coming off the lows of their patterns, as we've seen over the last month, roughly. So I think that's kind of the key here. And I'm just sitting here waiting to see if this market just starts to roll. How many people think we're going higher from here? Let's take a poll. How about lower? Anybody think are we going to roll over soon and head lower and to make new lows? Only one of you. Well, let's see where it's even up. We're lower is ahead by 1 vote, so kind of mixed. I think we're heading lower at some point. Where that actually occurs is another issue altogether. So it's a matter of kind of sitting around and waiting. But in the meantime, just approaching the market as a day trading game is what it's really become, and sort of thinking like an algo. So when things stretch too far one way, look for them to turn back the other way. So that's basically what I do. And I've been able to make progress, but it's not, the kind of big money progress that you're going to make when you can catch something and build a big position and then ride it for a period of time. So maybe it'd be helpful to look at some of the things on my buy list currently. Whoops. Let's just look at things I'm watching. These are ugly ducklings. Here's Acuity Brands. It's coming up. But that looks very V-shaped on the weekly chart. So to me, that maybe that's it's just a pod, a punch bowl of death, and it's going to roll over and die. So maybe that's what happens. ALK is another one I like, and that one's worked okay. But you have to buy it on weakness. Amazon is another one of these that has tried to turn, and you have to buy it on weakness and maybe short into strength. The water utilities have done pretty well. You got hit on American Waterworks, and then it turns around and gaps to new highs. So that'll screw you up pretty good. WTR is another one of these, Aqua America, and it's hanging in there. But you can see not really going anywhere. Alibaba is one that's an ugly duckling on my watch list. It's above the 50-day. Here's another one of these situations. Above the 50, below the 200, hanging along the 10. And not really definitive one way or the other. Just kind of trundling sideways here. I think maybe if it got to the 200-day, it might become very shortable. Otherwise, pullbacks might make it viable. But again, I'm looking at it in terms of a range trade. And I don't think I've ever really done that in my career, or at least not as much as I do it lately. So anyways, let's see. Well, it seems like most of you, as I'm tallying up the results of our scientific poll here, it's a majority of you by 5 to 1. It looks like if I can eyeball this right, believe we're going lower. And since you guys, I know our members are incredibly smart traders, and I've met a number of you, and I believe that's true actually. And there are some newbies and people learning. That's fine too. But I think we may be onto something. So we'll have to track that. It'll be like the AAII poll, except it's rather than being a contrarian indicator, it'll be a confirming indicator. So anyways, let's see. Avago. Here's another one. We put this one out. Did we put this one out? What, Dr. K?
I was going to say, well, what I wouldn't be surprised happening, since these tops take a long time to form, is that we'll get a rally going. Maybe we'll go as high as questioning old highs in say the S&P and the Nasdaq. It's just enough to restore some confidence and some bullishness of the AAII lopsided. And at that point, at that juncture, the markets will get hit by some bad news, and that'll cause a new downtrend to emerge, or rather a continuation of what started in the middle of last year. But as far as the market just going belly up and just repeating 2008 or worse, I think that the central banks around the world and the Federal Reserve are very well aware of that possibility, and so I think they're going to do anything they can to avoid it, because ultimately the 1% out there, they call it 1% versus 99%. They obviously want to protect the 1%, and the 1% tends to be invested in hard assets and equities. So I think they're going to do everything they can to keep this market afloat and avoid any kind of real substantial correction by any means. And that means just endless printing of money. And so at some point, yeah, there is going to be a crisis is going to reach a climax at some point. But maybe that's a year away. Maybe that's 2 years away. Who knows?
Or maybe a day away. So I don't really think you can project one way or the other. And the other question becomes, in terms of central banks just printing ad infinitum, or shall we say ad nauseum, eventually, and we've already seen this to some extent, is that it loses traction. And when there's a realization that the central bank's bid is the last bid to hit, that might be when we see things start to collapse again. So, but I do think it's mostly bear market rally. We'll see where it ends. So let's go through some of these. Here's Avago. Okay, now is this a double pod, or is this going to break out? Now you're breaking out. Here's this gap up move. You buy the pullback here, fills a gap, and it breaks out. Now, Dr. K, would you buy this breakout here? Is this looking healthy? Is this the type of thing you want to buy into?
Well, in healthier markets, in base breakout markets, this would be an interesting name, because it had a gap up on the strong earnings report, and it looks like it's clearing, it's clearing its way to blue skies here. But this is not that kind of market. So of course we want to be buying on weakness, as we demonstrated through our reports and our weekly summaries. Because then when you're buying on weakness and you know that your risk is literally 1 or 2% when you're buying it, you're gonna live to fight another day, to trade another day. And so that's essential. And when you're buying up here, if your trade goes against you, where are you going to get out? You can't get out at 1 or 2%, otherwise you can very easily get whipped
Yeah,
off your position.
unless you just use the top of the base, or like 148 is a really tight stop. But yeah, you're right. And the other thing I might point out is that this could become shortable here. So that's another thing to keep an eye out for, because that's a possibility. They'll fake you out by trying to break out, and then they'll, like here on the right side of this pod, now you're at the right side of this one, and that's where they roll them over. That's usually how you see a pod fail. So you want to watch for something like that, because it could make it shortable again, and that's something I'm keeping an eye out for right now. So the Netflix is working right now. Getting the data keeps rallying, so I just keep peeling that out. The other one I'm watching again, also here, is Facebook. I've got a little bit short on it here. It's not really moving that powerfully for such a big stock name, because I think it's mostly this rally is being led by utilities, and oils probably are moving to the upside as well. But let's just continue going through some of the names I have on my buy list. Here's another one, something of an ugly duckling. But again, when I look at these, they've had great moves, and I'll play them on the long side as long as they keep going higher. But again, you're seeing this sort of action where you get this very V-shaped, pod-like action in here, and to me this is suspect. So that's why I say I think we're in a bear market rally, because of the way these patterns look to me. And I judge the market's potential on the stocks themselves, and I'm not just looking at breakouts, because if you're just looking at breakouts, you probably wouldn't even have come into the market back in mid-February when everything was turning. So you have to be willing to be a little bit creative here and figure out that in this market, job type rallies or junk off the bottom type rallies they've been quite common over the last several years. I know yesterday was the 7th anniversary of this great bull market. So the comment from somebody I think is interesting here. He says, I agree with the day trading approach. I stopped swing trading and started day trading in January, and have been successful making money in both directions when prices get extended one way or the other. Yeah, and that's the kind of market you're in. And this is where I'm seeing a progression for myself, is that the prior couple of years, I've been more of a swing trader. I'm looking for multi-day moves, okay, maybe even a couple of weeks worth of a move. And that sort of approach made me triple digits in 2014. Last year I was up about 10%, but at least I didn't lose money, and I overplayed my hand a couple of times and couldn't get anything going. But that approach worked, and now it all seems to have compressed. So now the only way I find to make progress is by, and this is probably something I probably should have done last year, towards the latter half of the year, is stop trying to swing trade things and start to day trade them more. And when you start doing that, I think that's more effective in this market. But you're just noticing how your time frames are compressing. And I'm not sure what that's telling me, but it doesn't seem like we're in a normal market environment. We're in a very strange, unusual market environment. That's why I tell people, if you can't adapt and you don't have the frame of mind to be nimble and to keep things tight, and be willing to be an active trader as you actively manage positions to ensure that you're making money along the way, then you probably should just be in cash. And I know a number of traders who just kind of thrown in the towel, and they can't make money in this market, and they've stopped trying, and can't say I blame them. It's very much like that. Anyways, let's pummel through here.
Last year was considered one of the most challenging years to make any headway in many decades, and this year is even more of a mess. Which, from my perspective, from a historical perspective, I'm absolutely fascinated by this kind of action.
Yeah.
And actually, what I like about the VIX volatility model is that it's like a barometer. It's like a gauge. It has lots of gauges on the market in terms of being very sensitive to small changes in the markets. But over many signals, it tells an interesting story, because because I've practiced it many, many years, and what's interesting is that its nature makes it tailor itself to the behavior of the market environment. So, for example, this year, it's never had so many signal changes in a 10-week period in the history of its run. And, of course, I'm not surprised because if you look at what the market's done this year, it's all over the place. And so this model is going to get whipsawed. It's going to have a lot of false signals. But what I like about ultimately how the model is working is if I just let it be and do its thing, then it is up quite nicely this year. And if you also took the quick gains when you had them, as I know some people did, then that even adds further to your profitability. So, in other words, you can have a lot of turbulence in the market environment, but that doesn't mean that this model can't do well in that environment. There are types of environments, though, like the post-flash crash of 2010. That was a good period, but after the aftermath of that crash, the markets were almost confused and dizzy, and there was so much what I call chaotic noise in the markets, and that was one of the drawdowns that this model had. It couldn't make heads or tails out of all the riptides, I guess, going on in that juncture, which lasted about 2.5 months. So I like that. It's kind of a nice barometer for market conditions, and so obviously right now it's issuing a lot of signals, and as far as I can tell, this volatility in the markets is probably not going to abate. I would be surprised if the markets just are off to the races, because we never saw that last year, despite all the central banks lowering their interest rates, and so they can continue to do that. And I don't think it's going to. I think that this elevated level of volatility, going over action in the markets is probably going to continue, which means day trading is probably the best bet. Certainly position trading that went out the window quite some time ago, and buying the breakouts. And so yeah, your time windows are getting more and more compressed. But again, there's always a way to skin a cat, and that's what the challenging market environments push you to do. Gil, your mic's not on.
Okay. Well, let's go back. I was looking at Cray. This one's hanging along the 10-day, 20-day line here. I don't know if it's building a base or what, but it doesn't act too badly. That's one of the few leading stocks that looks interesting to me. You had a pocket pivot, I think, right here on this day. That would have been 1, 2, 3, 4, 5, 9 days ago. Of course, that didn't lead to anything. The stock rolled back into the 20-day line. Maybe it bases around. That might be one to watch. I think that's a cloud play, data storage play. So another one here, Cree. This one was acting pretty well, but it is pretty typical of this market, and this is why I like to take profits when I have them, because you'll see that what happens here is this thing's nice and orderly. You buy every pullback, it runs up, buy the pullback, and then all of a sudden, slam, it gets hurled back to the prior range breakout point, which is right around just above the 28 level in the 50-day line, and then it drifts back up. So you could have bought it right there, and you'd be up close to not quite 10%, but decent bounce off there. And that's sort of the contrarian view, is you want to sell into the rising trend channel or the upside move here, and then come back on the weakness when it looks real ugly. So we looked at some of these. Here's a funky one. I was telling Dr. K about this one down here. Of course, we didn't put it out because it's just kind of small, but to me, this is like the plug power of 2016. So it's got this big parabolic move to the upside. These guys make these Vortec pumps that are used not only in fracking but also in desalinization plants, which might be the next big investment theme. So that's something to think about. But in my view, if this is really getting going, you see it has a long history of doing nothing. Maybe this is getting going. Maybe it's going to break out and become a big stock. I don't know, but I'd keep an eye on it. It's kind of an early idea. Maybe this is something that can drive some excitement in this market, but it's kind of cheap right now. But it might grow up, so keep an eye on that one. So we looked at EOG, right? That's whoops. coming up off the lows here. But you can see a lot of these oils are heading up. I think the bounces are normal, and I think a lot of these stocks are actually heading up into areas of potential resistance. So I don't think you want to get too carried away with oil stocks at this juncture. I know oil. Where's oil at actually, Dr. K? Is it near 40 right now?
It's about 38 and change.
Yeah. So I was saying a couple of 3 weeks ago that a move, you could see stocks rally if oil rallied back up towards the 40 level, but that would be a normal kind of rally, and could that would just be a rally up into resistance, and then you roll over again. So I'd be more opportunistic with these oil names. Let's look at this Fabrinet. Okay, this is a piece of garbage. It breaks down, bounces off the 58. It's looking ugly. Volume's heavy, and then it lifts back off. Another one that's related. It's a cousin. Same thing. I mean, this sort of stuff is very difficult to deal with, and it'll drive you batty. But these are smaller, thinner stocks. I think you're always best off, like with the MTSI, with the SMCI, all of these, you're better off trying to come into them on weakness. And maybe even Solar Edge is a similar situation. We looked at Godaddy. Here's FXCM. This is actually my Forex broker. Now here's another breakdown, but it's getting support off the lows. But it was acting well until today, so now it's busted. Maybe they lost a lot of money in all the volatility in the euro yesterday. We looked at First Solar. Here's another one, 5 below, hanging tight along the 10-day. Maybe that looks okay. We looked at Godaddy. Here's an oil gold stock acting pretty well. Silver Wheaton's another one that's acting pretty well. But again, these have to be bought on weakness. You cannot chase them. If you do, you're just asking for trouble. Nvidia has been rallying back. Whoops, let me get that right. Sort of hanging up in but again, is this a pod or is this a new wonderful base and the stock's going to launch higher and become a big new leader, or is it just a pod? And you got to wonder when you're seeing this. I'm starting to wonder whether it is a pod, so I'm sort of keeping an eye on this one as both a short and a tradable long off the 20-day. But if it busts a 20-day, then I think it's probably heading lower, so that's one to keep an eye on. But it's been on my buy list. Panera's one that's been on my buy list, although I shorted it the other day here. I think Morgan Stanley or somebody came out and upgraded the stock, saying that they like their digital initiatives. It's like, come on, it's just a restaurant. The digital, and what are they going to do? Sell food through the internet? You're going to print it on a 3D printer, a 3D food printer. Maybe if they did something like that, it would be exciting. But to me, that just looked like a setup, so I shorted it. It comes into the 20-day line, and probably just take that right there and just leave it. The other thing you can do is, if you did short something like that on that kind of reversal, is take a partial profit at the 20-day line and then use some sort of a trailing stop, maybe the 10-day. But that's an unusual situation. But with my experience, you see these things get extended, and then you see an analyst come out and give some bizarre reason for raising their rating on the stock. So in this case, it was, I forget, it was Morgan Stanley or JP Morgan, one of those. You guys can look that up. But the analyst was pumping the stock because he felt that their digital initiatives were a positive for the company. And, you got to think about that for a second. It's just a restaurant. What are they really going to do? So Priceline is another one of these. Okay, look at this. It's coming up. But again, that's very V-shaped, and can this sustain? It just doesn't seem like it can. So I'm skeptical here. We've looked at CRM. That's on my buy list. We looked at Silicon Motion. That's trying to break out, so that's acting okay. Some have talked about Square. They came out with earnings the other day, not really happening. Kind of a bomb out there. Tesla is coming back, and this looks like, again, a V-shaped move. It's going to run into resistance somewhere. Maybe it gets to the 40-week line or the 200-day line first. So I'm noticing Netflix just keeps going lower. Now I just wish this data would give it up. Why don't you guys all jump on that and knock it down a couple bucks for me, okay? Let's see, NASDAQ OMX, that's making new highs. A little bit extended. That's acted pretty well. Trimble's another one that has moved higher. It had a pocket pivot here, but it's just hanging along the 10 days. That become a new hot leader? I don't know. I suppose we'll find out, won't we? Tripadvisor. Now, this is one that is stuck below both the 50-day and the 200-day moving average, and it did not hold the 20-day, and it's rolled over. So now in the rally back to the 20-day, maybe it becomes shortable again. So I'd watch this one. There's Priceline, and there's also Expedia. And if the group starts to weaken, you see Expedia coming up to the 200-day line. So maybe this becomes shortable at this point. I don't know. But something to keep an eye on for now, I think. So now they're really pumping the market. We're up 223. I guess if Germany went up 3.5% or something like that, then I guess we could do the same thing, right? So that means we're only halfway there. So you might as well get long and strong, everybody, and ride it up. Somebody said, digital initiative is to reduce headcount. You replace order via touchscreen rather than taking a cashier. Not defending, just informing your call was the right one. Yeah, I guess that's the ultimate test. But yeah, but is it all that exciting? You know, okay, they're going to fire a couple of workers. You know, so what? I don't know. It just didn't strike me as something to justify a big upside move in the stock that day. So. We looked at Walmart, not yet. Let's see. That's looking like it's trying to go higher, but I don't know. It doesn't really thrill me that much. I wouldn't really be buying it. WebMed is another one that's hit my watch list. It's had a pocket pivot there, and it's just hanging along the 10-day. So all of these look great. So basically what you're waiting for is for them to blow up. So, you know, because they look so good, because that seems to be what happens in this market. So to summarize, you know, there are some things that look viable, and I think if you're going to test alongside, then you need to do it on weakness. So you got to step up when you see the market coming in. You look at your buy watch list and see what's coming into a viable zone. Otherwise, you're hanging back and not playing in the market. Now, at the same time, when the market rallies, you've got to keep your eyes on some of these ugly ducklings, because a lot of them are coming up into areas of potential overhead resistance, at which point they might be very shortable. So you want to be completely open and ready for whatever the market throws your way if you're an active trader. So if you're a long-only trader, then your only strategy here is to assume that the rally has legs and will continue until you have some evidence that it isn't. So basically that would be, if you take a position, your first evidence is going to be that you get stopped out, but you want to keep tight stops and be looking to take profits as you start getting up about 10%. That's my general rule, unless I start to see something hit my trailing stop. So that, you know, that's really the way to approach it. It's worked so far, but I'm not going to tell you I'm making big money, but it's pretty steady, and as long as I can continue that pattern, that tells me that that's probably the correct approach, at least at this juncture. So still a very difficult market. It's not easy, and I'm just happy to be up as much as I am, well over 10% for the year, and hopefully holding that. So Netflix going lower, so that's helping. See? You'd rather be lucky than good, I suppose, when it comes to something like that. But Biogen's another one. It's kind of weak, but notice how it has these rallies into the 50-day. But you'll see that. So you can go back and look at our webinars from earlier in the year, and all the names that I was talking about on the short side that came down in January into February. A lot of those have jacked to the upside. So you want to check those names and see where they are in their patterns, because a lot of them may very well be in shortable positions or approaching shortable positions. So if you are a short seller, okay, and a nimble trader, then you want to be aware of those, because that's where your opportunities will be if the rally fails. And I don't think you can make any assumption about how far it's going to go or how far it isn't going to go or when it's going to roll over. You just watch the stocks and be ready to act when the time is right. Anyways, that's all I've got. You got anything else, Dr. K?
I'm good over here. I think just play lightly. If the market is frustrating you, that should not be a reason for you to position size and heavier, trying to make back what you lost. That's a recipe for disaster. So I would say, this market environment is unusual, and there's nothing wrong with putting on smaller positions, and because at least it keeps your toe in the water, so that when the conditions change once again, and they will, you're ready for it. As opposed to just shutting off the computer altogether and not looking at the markets because you're throwing in the towel. And obviously when people do that, the more people that do that, that often is the beginning of a change, of a material change in the markets when it does occur. So keep that in mind and keep a trading journal because, as we always say, that these markets are so unusual and they're great learning environments for shoring up or exposing any kind of limitations within yourself or emotional weaknesses that you might have with regards to trading. And this kind of market environment will amplify those immediately. So in a sense, it's a very utilitarian market for learning.
Okay, on that note, you guys, good luck and have a great weekend. We'll catch you next week. Take care.
So long, everyone.